Welcome to India Decides, the FI View with me, Tanveer Gill. We're back with another edition of the show, focusing on what foreign fund managers are making of their India strategy given the global backdrop and the key risk in the elections. My guest today on the show is Sanjay Guglani, who's CIO of Silverdale Capital. He joins me from Singapore. Just a quick run through Sanjay's background. As CEO of Silverdale Services Limited UK, Sanjay has channelized over $4 billion of investments into emerging markets, including $250 million of controlling stake investments in Philippines, Indonesia, India, and this has been in joint ventures with marquee investors such as Goldman Sachs and Morgan Stanley. He was instrumental in creating offshore equity as well as credit derivative markets for mid-cap Indian corporates. Sanjay, in fact, is a Sloan Fellow of Management from London Business School. Sanjay, good to have you on the show. Thanks very much for taking out the time to speak with us. Now, first up, really, how much upside would you give to the market in lieu of the big event in elections? We've seen a 10% gain so far into the year, adjusting for currency appreciation as well. Do you expect 7,000 plus post-elections, another breakout, that is?
See, we all will love the market just to go up forever and forever. But as fund managers, we need to be more rational than emotional. Would the market go to 7,000? Potentially, yes. Do I care? The answer is no. Because I do not believe that the index represents the GDP of the country. We would say, for example, about 35% of the index comes from IT and from oil and gas. The one-third of GDP of India doesn't come from oil and IT.
Give us a sense, sitting out of Singapore, what is the mood in India in terms of money waiting on the sidelines? We've seen about $10 billion come in to India through equities and debt so far into the year. What's your sense on the kind of potential there is if the market gets re-rated from here?
The good and the bad news is this. 80% of the FIs in India are global funds. Some of these funds are bigger than the entire GDP of India. So in terms of potential, the potential is huge. Absolutely huge, no denial. But it's also true that these funds are not wedded to India. The allocation to India depends on relative returns. Lately, India has benefited from the turmoils which we saw in Turkey, in Venezuela, in China, in Russia. So these questions of relative returns, and of course, not to also, forget the facts that the environment has to be sanguine. The policies have to be conducive.
Sanjay, the broad expectation from elections is that there would be perhaps a thumping majority for the BJP. How are FIIs such as yourself positioning yourself around elections and then, of course, the budget? Over the next 3 months, what's your strategy for the Indian market?
We all wish that we have a strong government in India, and we believe that a strong government would be able to unleash reforms which can take the Indian growth rate to the next orbit. But we should also keep in mind that they require certain time. India has two issues. One is perception. Yes, a thumping majority will definitely help that. But equally important is deliverance. And the deliverance would take time. And it begins from basic credibility. The FPI rules were announced almost a year and 2 months ago, correct? Still now, they have not been operationalized. The RBI allows us to do FX hedging in India. But they determine when I have to do, how much I have to do, how do I roll. Come on, that's not how it works. Now, these are the, I would say, smaller issues. The bigger issues are structural. We would have about 240 million people adding to the workforce in the next 10 years. As per the government estimates, the number of jobs created would be 150 million. We have 100 million deficit in jobs. I'll tell you one more interesting thing which are not debated in India. We have just 5,000 IS officers talking and administrating a GDP of about $1 trillion. Just imagine 5,000 people for 1.2 billion population. These are the factors which actually feed into the investment decisions when an FI were to invest into India. So the budgets, the elections are important, were not so important.
Right. India currently has two risks, Sanjay. Election risk as well as the risk of El Nino event, which can have an impact on the inflation situation going forward. How would you play and prepare for these risks in the context of sector allocation in India?
See, elections are part and parcel of democracy. So when we are investing into emerging markets, we take that into cognizance in terms of our strategy. So rather than being disturbed or being taken by flight by the elections, we rather love to be more sanguine about the whole thing. Our strategy continues to be stock specific in the emerging markets because we believe that the index doesn't reflect the GDP in various emerging economies, including India. Coming to the El Nino effect, yes, we are cognizant of it, and we would take corrective steps as and when the things unfold. Right now, the good and bad news of the Indian stock market is we do not have a classical agriculture play in terms of where we would have a maximum impact. In terms of consumer goods, there are many other factors than El Nino which are coming into play.
Sanjay, even as economists and investors believe the macro risk for India has receded, the rating agencies are still a bit guarded. How much of that influences your opinion when you're looking to allocate more capital into the Indian market?
I would say that most of the rating agencies are more sanguine. They are most grounded to the reality. And does it influence us? The answer is yes. And it's all for good measures. It gives us a balanced opinion. On one side, we have people that are grounded, and some people that are exuberant, and it helps us to take a better decision. So, all in all, I think it's a good to have difference of opinion because that's what makes the markets in the first instance.
Right, Sanjay, for someone who watches the Indian market very closely and also, looks at earnings, from a quarter-on-quarter basis, given that your focus is picking stocks at the right price point, give us a sense, post FY14 numbers that you've seen from all the IT majors and what they've guided for in FY15 to the extent that they can, what is your order of preference now between a Wipro, TCS, HCL Tech, as well as an Infy?
We would refrain from talking about specific targets, but yes, we like TCS and HCL Technologies.
Sanjay, do you see IT, pharma, healthcare as a segment performing well in FY15 as well? Any top ideas that you have from these sectors?
We believe that they would continue to be defensive sectors. Indian IT story is far from over. We see a lot of value in most of the companies across. In particular, in IT, we like TCS, we like HCL Technologies. Pharma story could be a story which could be competing with IT in terms of the opportunity available. In pharma, we of course like Divi's Lab, we like Natco Pharma. Sun Pharma looks to be an interesting bet. And I would suggest the investors to take the benefit of the merger with the Ranbaxy and the FNOs and the ARB available in the market.
Right. Talking about your fund, Sanjay, in March in the rally, your fund increased exposure to Apollo Hospitals and KPIT Technologies. The fund booked partial profits in Colgate-Palmolive, ITC, Natco Pharma and Petronet LNG. The fund is in fact also making trading gains in Power Grid. My specific question there is, why did you add Apollo and KPIT Technologies to your fund?
We like Apollo's business franchise. We are impressed with the management's capability of execution. In next 2 years, the capacity of Apollo Hospital would increase by more than 25%. That's a huge value trigger which we foresee. Their pharmacy division is doing very, very well. So that makes a good investment case, specifically now that we are seeing certain softness in the prices. Coming to KPIT, it's a fantastic company, quoting a discount to the peer group in the mid caps. We like it particularly because it allows us diversification away from the BFSI segment. Their domain expertise in automotive electronics is brilliant. They are one of the few companies, those who have expertise not only into AutoSAR or Jaspar, but also in Genevieve. So practically speaking, they are talking about the entire globe in terms of the automotives whom they can service.
Sanjay, what's your view as far as the energy space is concerned, the oil marketing companies, ONGC, Reliance Industries?
As a fund, we refrain from focusing on companies where the profitability is determined by certain bureaucrats. We would prefer to to invest in companies where the cash flows are much more predictable.
Yeah, sure. But the larger issue there is, the outlook towards PSUs. How are you positioned among PSUs given the policy trigger?
We are not great fans of PSUs because unlike in UK where PSUs actually became private sector and there was a huge value unlocking, in India we haven't seen that the decision making actually going into the hands of the management. Having said that, there are a few exceptions which make interesting cases. Petronet LNG would be one. Power Grid would be one. We love Power Grid's business model. We know sort of assured return the company gets. We know sort of capitalization they are doing. So those are exceptions rather than a rule.
Sanjay, banks and cap goods have done very well in the recent run-up that we've seen for the markets. What are your preferred bets within the banking as well as the NBFC space at present? Also, would you be bullish on cap good names at this point?
We would be slightly more cautious in these sectors. We do not think the stock market has fully discounted the non-performing assets which are held by the Indian banks. We do appreciate and understand that in case of upturn of the economic cycle, and which we believe that we are close to bottoming out, banking is a good sector to play with, but given the inherent NPAs sector, we will be very careful. Add to it the fact that the Indian public sector banks require huge amount of capitalization and therefore the equity dilution in coming days. Coming to capital goods, I think it's a bit too early to bet upon those things. We would of course keep them under watch.
Sanjay, while consumption and infra demand has taken a bit of a backseat, how would you look at playing consumption and infra-related stocks in the Indian market?
Infra is more policy-led, so we hope that the new government would be more proactive and we would see certain initiatives being taken by the government to kickstart the infrastructure sector. Of course, it has certain amount of structural issues. And when I talk structural issues, I'm not only talking in terms of the environmental issues or clearances issues, etc. out there, but also in terms of how the funding for these projects are being done, in terms of multi-layer funding, which is pretty often in India, where the construction companies give the toll and toll company gives the construction contract inter se. India also has issues because India doesn't have a sovereign curve. So for people to raise long-term money is an issue. So those are things which need to be taken care of in terms of infrastructure things. Having said that, coming to the consumption portion of it, we believe that the rural, the employment guarantee scheme was a fantastic scheme, but very ill administered, which has created pockets of wage inflation in rural India, and which has in turn led to shrinkage of labor pools. So there are a lot of infrastructure issues in terms of consumption which also have to be taken care of before we could be very bullish on those sectors.
Right. Sanjay, given the fact that your focus is stock specific and you have a bottom-up approach in the market, what are your top 3 long-term conviction ideas among large caps as also mid caps?
Let me preface it by saying that when we like a company, it's not that we are going to buy and hold. It's more likely than not that we would increase our stake as the company progresses. And of course, if the prices run off too fast, we would be very happy to book profits. Having said that, we love ITC. We love ITC not only because the amount of cash it generates, but more importantly, because of the FMCG business. The FMCG business of ITC is bigger than Dabur, bigger than Godrej. The cash flow is higher than Unilever. And the best position of ITC is the ability to launch pan-India brands. That's absolutely unparalleled. For us, the additional kicker comes from the fact that the stock is very liquid and we can effectively use FNO to protect our downside, to book profits, and of course acquire cheap. Coming to Natco, we think it's a fantastic case and the timing is brilliant. As everybody knows, Capaxon is the key value driver for Natco, and lately the price had a big crash because of the fact that Teva's challenge was accepted by the US Supreme Court. Now that's a brilliant opportunity for our investors, because in the worst case, if the Capaxon is launched as scheduled, the company would still make marginal profit on manufacturing. And of course, in case the company does win the case, the amount of profit it will make from Capaxon alone would be almost 4 times the profits the company has today. So that's a brilliant company to look into. We like Jyoti Lab because we believe that the synergies from the acquisition of Henkel have not yet been fully reaped. With the fantastic management under Raghu, we see huge amount of synergies coming, not only in terms of the complementary distribution channels of the erstwhile Jyoti and the erstwhile Henkel, but also in terms of new launches out there. Just to give you a flavor, we believe that the addressable market of Jyoti has increased from almost $500 million to $5 billion. That makes a tremendous investment case. We already discussed earlier in terms of KPITA sector.
Sanjay, since you look at the debt side of the market as well, what's your take on what's the potential money-wise that debt paper in India can draw from foreign investors?
That's an interesting question, and I would like to answer it from 2